They could go less. They are a lot less now. 60% in equities, 40% in
Right.
in fixed.
In
And it has changed. You know, it used to be 50-50. They told us we couldn't be competitive. We were 50-50, so we did go to selectmen and ask for a change.
Right. And you also said that the manager had gone somewhat into cash. Does that mean he's lowered his equity position?
Yes. I don't know what the equity position is. I think last time I looked, I think we were like 38% in equities and all the rest in fixed. We were much lower. And by the way, we're not in individual. I don't know if anyone cares about this. We're not in individual stocks. We're just in funds, which he says spreads the risk, and we do listen to them.
Yes. So just for everybody's edification, and I'm sure you're all mathematicians because you're on the finance board, if the fund is down 20%, say it's $100, it goes to $80. To get back to the $100, you have to increase by 25%. So we're looking for the stock market or the total fund to increase 25% to get back what we've lost.
But it has to be the stock market because, I mean, the bond market moves very slow. We're in what they call short durations, but it's still about 7 years. So our bonds are they're 4, 5, 6%. I don't even know if they're even 6%. They're 4 or 5% because they're safe bonds, short duration. So for us to make money, we have to find a big move. And again, we invest in funds, and again, you don't have the big move down, hopefully, but you also don't have that big skyrocket up either.
Thank you.
So okay.
Yeah.
Any other questions? Yeah. Quickly.
I think you've hit on a critically important issue here, and that is the issue about what the actuaries tell us and what management decides to do. This is a bombshell. My own personal opinion is, and I may regret saying this in public, but my own personal opinion is that this is not just a problem for this town, but it's a problem for this country. My personal opinion is that the actuarial returns that are assumed on your investments should either be the higher of the 10-year Treasury bill return or what the fund generated in the previous year. If you got a return of 3% the previous year, and you assume a rate of return of 8%, you're going to go down the tubes. You can't do that because you're just hoping that all of a sudden magic is going to happen. So I think the solution to this problem, and it is a huge problem with millions of dollars at stake, is that the assumed returns must be predicated on something which is real. And what is real is what the 10-year Treasury bill is paying and or what you have achieved in the previous year, not what you hope to achieve in the coming year. So I think, John, that you put your finger on a critically important issue, and maybe it's a topic that should be discussed by itself because there are huge dollars involved in this and great danger also.
Well, the 10-year Treasury was 3% when I left the office, so that means we need at least $1.25 million plus. Yeah. So,
and you know, if you go to Paul's point, we have done 7.92% up to this year. So and by the way, Paul, we have our manager look the number and say, based on everything you have, is 8% unrealistic. If he said yes, unrealistic, it's easier for him to give us a lower number. It just means the town pays more. He has a lower goal. So I mean, he keeps telling us it was realistic, at least up to the summer, it was realistic. Is it realistic now? I don't know.
My takeaway is it can't be ignored, and we need to do something a little bit more than what's on the table. And the worst case scenarios, we are funded or slightly overfunded if returns, and that just means we have to pay less next year. But
I was going to say it'll adjust next year.
Obviate
Real quick, is the rate of inflation taken into account at all in the actuarial calculation?
He uses all. Yes.
It is.
Yes.
And what effect would it be?
The rate of inflation only in that the payments we make go up. We make payments that are based on people's last 3 years of salary, so their salary is what we use to pay out all the retirees we pay out. So yes.
Like at a national inflation rate, if it was is not taken into
not a fixed national. No, because if everyone in Newtown didn't get raises and inflation was 10% a year, it would be based on his actual calculations would say, no, their salaries have stayed flat, so the payments would stay flat. So it's based on their salaries, which usually go up 2-3%, which track.
Anybody else?
We're assuming 5% on the salaries, so that's good.
You guys are assuming 5.
That's what they are,
Yeah.
actually.
Tom, thank you very much.
You're welcome. Thank you, gentlemen.
Appreciate your
Thank you
time.
for all you
Very
do.
enlightening.
Thanks.
Thank you for taking me.
Yep. Judge? Sorry for making you wait.
Since you've already heard about the state of the economy and the jobless market, I just have to, here tonight, Bill Lavery representing the library with Peter Marshall, our treasurer and financial vice president. I'm asking you on behalf of the library board to give us the same amount as allotted by the Board of Selectmen. We had a very spirited discussion at the Board of Selectmen's meeting, and the figure for this year is the same as the figure for last year. We are changing our trustee of our trust.
Bank of America?
Yes. We selected Chase, but it has to go to probate court and down. It's down, the income is down. So based on last year, we're below last year because we have less income from our trust, about $4,500 to $5,000. But when times are bad, the business of the library goes up. 2 years ago, on a 5-year plan improvement, we opened a library for almost 9 hours more, for 9 hours more a week, because that was the #1 request of all the focus groups in Newtown. Since this recession has started last year, we have 20,000 registered patrons, 23% increase. 530 people are using the library daily. It's up 20%. Our audiovisual materials, DVDs, CDs, etc., use is up 58% in the last year. Our new borrowers are up 26%. Our computer use is 11% increase, over 1,000 print jobs, about 2,500 pages a month for the 11 internet and business computers on the 3rd floor. We have had job seekers seminars. Our business data is, on our computers, all of it's up. Our library is packed every day. The senior citizens use it. Everyone's using it. Our business is up 30%. So we need to sustain this type of market. And thanks to the Friends of the Library, we use the money you allot for books to pay the bills that go in arrears, because we don't have enough money to buy books and materials. Without the Friends of the Library, we would really have a lousy collection. And they are very good to us. They allot so much for each department. They review the requests. These folks, most of them over 60, are lugging books every day of the week, packing them and doing things. We couldn't exist without it. They're really, truly a community spirit. So on behalf of the library, I'm asking that you approve the budget the Board of Selectmen allotted us, which is the same as last year. And Peter's here to answer all the intricate financial questions. That's why I take the first ride. Peter.
Did you want to say anything, Peter?
Pardon me?
Did you want to say anything, or
I'm sorry.
did you want to say anything, or just?
No, I think Bill covered the situation quite well. The fact that our initial request was reduced by 3% makes us even with last year. But a very important point, as Bill alluded to, is that even with this new budget that you have before you, it really represents a required decrease in our expenditures, notwithstanding all of the increased usage in the library. And in fact, quite frankly, the situation, in the same light of what we were talking about on the pensions, it has deteriorated since that budget was prepared. For instance, like on fundraising, we have in our budget $61,000. Our best estimate right now for this current year will be that we'll come in around $42,000. So we're $19,000 behind right there. The situation with respect to our investment income